welcome back. We are continuing the topic, the zone qualification, and the last factor you should be looking to, to check out when you are marking out your demand and your supply zones is actually the risk to reward ratio. So the first thing is to look at how quick the movement was, how big, how strong is actually the movement away from the zone. Then the second thing you want to look at is going to be the break of structure, the move, the big move. Did it break structure? That's the next thing you want to look into. And of course, after that, you also want to look at the freshness of the zone. And when you're talking about freshness of the zone, you're talking about like how many times has price come to mitigate that particular area? How many times has price come into that zone, to retest it? Now, the last thing you want to look at is going to be the risk to reward ratio. Okay, so let's quickly discuss that. When you're talking about risk to reward ratio, you are talking about the amount of money you risk, that you are willing to risk in comparison to the amount of money that you will gain. More okay, like how much are you risking? How much are you actually putting into this particular trade? And how much are you looking to get from from that particular trade? So for example, let's say you risk $10 on a particular trade. That is your risk. Okay. It means that risk means that there's a possibility of loss. That's okay. If my analysis does not really go in the direction I want it to go, I'm willing to lose $10. That is what your risk is, okay? And in this example, your profit target is like $30. Now that $30 is actually your reward, okay? It means that you're willing to lose $10 on that particular trade. But if your analysis goes in the direction that you want it, it's going to like be $30. This is just for example, okay? Now, so the $10 is your risk and the $30 is what is your reward. All right. So when you analyze the market, using the first three factors that we spoke about, the strength of the move, the break of structure, the freshness of the zone, when you have actually analyzed the market and you find a high probability entry point, you should always calculate your risk to reward ratio. Okay, it's important. By that I mean you should know how much you will risk and how much your profit will be if the market goes in your direction, like I said the other time. So certainly we're going to be talking about these more and more every time that we're going to be doing analysis of market. Okay. Now, so to decide whether the supply or demand zone is valid, we need at least a 2-to-1 reward to risk ratio. At least a 2-to-1. In other words, if you're risking $1, you should at least be profiting $2. Okay. And of course, from what we're going to be the kind of entry protocol I'm going to be sharing with you later. With our entry protocol, we can actually have as much as 1 to 4, 1 to 5, 1 to 10, 1 to 20, as the case might be, of course. But no matter what your setup is, never ever risk more than what you are than what you are going to be profiting. So always your setup must be that if you are risking $1, you should at least be expecting to profit, $2. Okay, that is going to be like ratio 1 to 2. That's going to be the least. Okay, so If the zone has less than, 2 to 1 risk to reward ratio, you should simply ignore it, okay? Because even if it is a powerful zone, because if you trade low risk to reward ratio probabilities, you will end up a loser on the long term. It's just like this. Let's say, for example, the setup is giving you that is actually giving you the probability of you losing um $2 in order for you to gain $1. Okay, so now let's say, for example, you lose that particular trade. If your setup is always giving you um risking $2 to profit $1, if you lose a trade, it means that you will have lost $2. It means that if you are to keep going without losing two to gain one, you will need two successful trades to cover one loss. And for me, it doesn't just make sense, okay? When you can actually look for opportunities in the markets that can give you at least one to two, and basically, with our system, we can the least you're going to be getting the least you're going to be getting is going to be 1 to 4, 1 to 5, and and so on and so forth. Okay. Now, how do you calculate the risk to reward ratio? In order to calculate the risk, you need to calculate how many pips between the distal and proximal line. The distal and proximal line. When you are drawing your, I'm going to be, I'm going to show you how to do that. But of course, we've been saying that when we are drawing our order blocks, or when you're drawing out, or just shading out our order blocks, or our business candle. Okay, you know the part of that particular line that is closer to the current price, that is what we call proximal line, and the one that is far and further away from the current price of the market, that is what we call distal line. Okay, all right. So when you are talking about your risk is basically the distance between the distal line and the proximal. Okay, all right. Now, um, so, and how many pips there are from the proximal line to the next support or the next demand zone, that is going to be your reward. Your risk is the difference between the proximal and the distal line, while your reward is going to be from that your entry point, from your entry point to the next, the distance between your entry point and the next this next supply, or the next demand zone. Okay, certainly you're going to be getting more clarity as we go on. Okay, so let's quickly look at this. Let's quickly look at this. Now you can see we have a supply zone in this particular place, and here is our order block. Okay, now to draw out this order block, we need to put the line right, at the opening of that candle, and of course, and another line at the highest price of that particular candle. So this line down here is what we call our proximal line, because it is actually the nearest to um the current price in the market, and this is actually our D stack. Okay, this is the proximal, this is the distal. So the distance between the proximal and the distal is actually our what? Our risk. And of course, we're going to be taking our profits. We're going to be taking our profits, at the the support. Okay, at the next support. So if you are having an entry at this place, we're going to be taking profit at the support. That is actually, when we had this particular move to the downside, the price came to this place, found the support in this particular place before it began to reach, pull back to mitigate that particular place. Okay, so when price began to move downward again, we are going to, take our profit just at this, at that particular support level. Now, so if you are looking at calculating your risk to reward ratio, then that means that you're going to be taking, you're going to be taking your order block or your basing candle into consideration. You're going to measure the distance between the proxima, between the proxima and the distal line of your order block. Okay, that is going to represent the risk, okay, in pips. Now I'm going to show you how to do that, on your MT4. By the time I begin to, show you how, by the time we get into you know live chats, okay. But for now, just understand that your distal and your proxima represents the risk, and the distance between that proxima, proxima and the next support level, in this case, of course, that is going to be your reward. All right. All right. Now, this is another example of a supply zone, okay? Of a supply zone. And of course, we have a very nice supply zone around this particular place. So price came in to mitigate that particular area. Now, you can see that your risk is actually the distance between this proximal line and this distal line. Price came in, that represents the risk. And we are going to be taking our profit just around this particular place where price eventually found a support before it began to pull back. Okay, so it means that if you have an entry here, you're going to be targeting the same price. We're going to be set the same price where the market actually found, you know, found uh support, before it began to pull back into our supply zone. Okay, so that's where our reward is. So you can see that this is actually the risk, and this is the reward. All right. Now the same thing happens here. The same thing happens in a demand zone around here. These are order block, and it represents the risk, and of course price pull into that zone. And certainly we're going to be taking our profit in this next supply zone. Okay, so you can see that this is the risk, this is what we are risking, and this is what is our reward looks like. All right. So what is actually the summary of zone qualification? Now you know how to identify supply and demand zones, how to draw the zones, and how to qualify valid zones by looking at the following criteria: the strength of the move, the breakout of previous support and resistance levels. That is what we call break of structure, the freshness of the zone, and the minimum risk to reward ratio. Now, those are the things you need to look out for when you are looking into your charts. Okay. All right. So, um, we're going to end this particular module at this particular point. I'm going to see you in the next.